Once upon a time, yes, I'm going to tell you a story today. And let's see if you can guess the name of the company uh, by the time the story ends. Once upon a time, in 1873, this company made its first toothpaste, which, by the way, was sold in jars. In 1911, this company distributed 2 million tubes of toothpaste and toothbrush to schools and provided hygienists to demonstrate the concept of toothbrushing. Yes, this company practically invented the concept of toothbrushing. It came to India in 1937, and in 1976 it partnered with the Indian Dental Association and conveyed the message of oral hygiene. In 1983, it launched its first toothbrush in India. The company that the five sons of Samuel Colgate, formally incorporated in the year 1908, has come a long, long way. Today, the net worth of this company globally is $15.5 billion, and the net revenue in India is 4,400 crores. Colgate stands at rank 59 in terms of the world's most valuable brand. But the most beautiful thing about this company is that even though it is an international conglomerate, it has integrated itself into the Indian culture. Colgate offered a scholarship program to build an emotional connect with the Indian household to help children achieve what they aspire for. In 2020, they launched a Smile Karo or Shuru Ho Jao campaign, which showcased inspiring stories to exemplify Colgate's message of overcoming adversity and life's challenges with the positive power of a smile. Colgate India's share price has given 1,300%, 1,300% returns in the last 21 years. Hello folks, my name is Neil and welcome to this series of videos where we look at a list of platinum stocks. Today it's the turn of Colpal. This is a two-part video, and in part one we are going to take a look at the fundamentals of Colpal. And in part two, we will take a look at the technical analysis of Colpal and see if there are opportunities for long-term investors, swing traders, and intraday traders to invest in Colpal. All right, let's get started then. Let me open up Screener. And let's go to Colpal. Now, I've already given you a good history of Colpal, so I will not get into the history of it and what the company does. We know it's an FMCG. Let's quickly take a look, and I'm going to skip the graph section for the technicals in part two. Let's take a look at what Screener has to say about Colpal. The company is almost debt-free. The company has a good return on equity. The company has been maintaining a healthy dividend payout of 91.26%, which is a good thing. The Screener says that the stock is trading a little high, 38.59 times of its book value, but we'll take a look at that again in the technical section. The company has delivered a poor sales growth of over past 5 years. Let's take a look at that as well. Now, if you do a peer comparison as far as market cap is concerned, there's only one company that is bigger than Colpal today, and that is Hindustan Unilever. Which is a good thing. It's number 2 in the world, in the country today. Let's take a look at the profit and loss statements. The sales growth has been decent, as Screener already mentioned. It's just slightly lower than 5% in the last 5 years. But having said that, I'm going to give Colpal a discount considering it was the year of COVID, and we had 2020 here, but even then the sales hasn't taken a dip. At least it's been consistently growing in 2020 and in 2021, which I would consider to be a positive thing. The net profit has also been consistently growing, so I don't see any problems there as well, except for, I don't know. No, really, it's been growing consistently, even in 2020 and this year in 2021. The assets and liabilities also look rather healthy. So the liabilities have seen a healthy growth as the company has increased its market cap. And the total assets have grown at a much faster rate, at a faster rate than the liabilities that have grown. In fact, you can see that the liabilities actually took a dip here in 2020. And The assets as well a little bit, but not as much as the liabilities. So good, good things there. The ratios are also, healthy. The debtor days are, you know, they've increased a little bit, but then that happens when the market cap of the company increases. But then 11 days, 9 days, 17 days, this is not really a lot of debtor days. By the way, the higher the debtor days, the worse it is for a company. The lower the debtor days, the better it is. It essentially means that the company is able to return the money that it borrows from its debtors quickly if the debtor days are small. So it's able to return the money in about 9 to 11 days since the last 2 years. The shareholding pattern is a very important thing that we look at when we look at fundamentals. It's been at 51% consistently for the promoters. So promoters have not reduced their share in the company, which is a very, very healthy thing. The foreign institutional investors have increased their share from 13.25% in 2018 to 18.61% in June 2021, which is an excellent thing. It essentially means that the foreign institutional investors have faith that the company is going to give them good returns. The domestic institutional investors' share has reduced a little bit, but that has gone to the foreign institutional investors. It's really not a very healthy sign if the retail investors, the public, their share increases. It essentially means that either the promoters or the foreign institutional investors or the domestic institutional investors are dumping their shares into the market, which has not happened. In fact, if you look at it, the retail investors' share in the overall pot has reduced from about 22.02% in 2020 to 21.89%, which is a healthy sign. Now, one last thing that I would like to take a look at as a part of the fundamentals is the corporate actions. Now, the dividend, I mean, we've already seen that it's been giving out a very, very healthy dividend since many years now, every year actually, or every quarter in fact. And it declared a bonus in 2015, but then the face value of the company is already at 1 rupee, which essentially means that it's not going to be declaring any more bonuses. However, it may declare splits, and it hasn't declared any bonuses or splits since 2015. So there's a probability that they may declare a split anytime soon, which the shareholders can take benefit of. So overall, it looks like a healthy company to invest in. The question then arises is what would be a good price for a long-term investor, a swing trader, or an intraday trader to get into the share, to get out? What is the profit potential of the company? We will cover that as a part of part 2 of this 2-part video. That's all I have for you today. I'm always looking for feedback, so do let me know if you think, if you disagree with any of the ideas that I present here. I'd be happy to answer any questions if you have any specific questions. If there is a stock that you would like me to cover as a fundamental analysis and a technical analysis, do let me know. I'd be happy to do that as well. And I'm always looking out to learn new things. So this is a two-way street. Talk to me. Other than that, I hope we make a ton of money off the stock markets. Have fun.